I'm delighted to be here today with Professor George Feiger, Dean of Aston Business School. George, thank you very much for joining us, and I was very interested to read a little bit about your background as a professor in, if I may say, the early years of Stanford and before that at Harvard. So could you tell us a little bit about what it was like in the sort of 70s, 80s in
Well, I
Harvard and
was
Stanford?
an academic in the second half of the 1970s. I taught economics at Harvard for 1 year, and then I was an associate professor of finance at the Stanford Business School. The interesting thing about Stanford in the second half of the 70s, of course, was that it was the birth of Silicon Valley. It was the birth of the personal computer industry and all of the things that followed from it. And there was a huge outpouring of entrepreneurial initiative, and this certainly infected all of the students that we had at the business school. So many of them went on to found some of the core video game companies and all sorts of other technology-related enterprises. If I think of the MBA classes we had between 76 and 79, an amazingly large number of these people went on to found or run successful technology businesses. So it was a time of great activity and ferment. From my point of view also, it was a time when these American companies were starting to expand internationally, and I was involved with a number of them because I taught, amongst other things, international finance, and they were asking very basic questions. How do they deal with currency risk? All these sorts of things which people don't blink at today, but were all novel questions at that time.
And after that sort of 4 years at Stanford, in that, as you say, that ferment, that entrepreneurial ferment, you moved on. Can you tell us a little bit about the next phase of your career?
Well, the entrepreneurial ferment, in a sense, caused me to move on. In addition to teaching MBA classes, I taught executive classes, and a lot of these people were executives from these companies. And I noticed that the questions that the executives asked me were much more interesting and much more difficult to answer than the questions the students asked me. So I decided perhaps I was in the wrong place and I should take myself to where the questions were more interesting. So I essentially resigned from Stanford and I left. And I spent 1 year working for the Bank of America, because I knew the vice chairman of the Bank of America quite well, and then I moved to McKinsey, and I spent 7 years with McKinsey in San Francisco and 8 years with McKinsey in London.
And was that really a very sort of globe-trotting kind of world then that you moved in, looking at top corporations and struggling with very difficult management challenges? Well,
from the point of view of a university, I would say this. I think I was the first professor that McKinsey had ever hired.
Oh, really?
Indeed, most of the people in McKinsey's San Francisco office were my former students, which was quite amusing. But what I did learn, and which is very relevant today in universities, the most abstract and technical of things that I had worked on in research and had taught at the university turned out to have enormous practical value in the running of businesses. And indeed, at McKinsey, we then invested a lot in intellectual capital, in people with PhDs, in people who did very sophisticated analysis. And often there's an assumption that there is some gap between the so-called ivory tower and reality. And what I can tell you is that in my working experience, even the most esoteric of these ideas could be applied. I'll give you one example. One of the questions I actually was asked to address was how much one should invest in maintaining the life of oil fields in the North Sea. And if you think about it, my background, after all, was in finance, and what did I know about oil? But the interesting question was actually an investment question. And it wasn't so much an engineering issue, it was really a question of what an oil field was. And an oil field, if you think about it, is an option on the price of oil. The price of oil is very volatile, as we've noticed in the last few weeks. And if you did a conventional analysis, you did a net present value, you'd say, oh, you know, it cost me £1 million to keep this well running for 5 years. What could I get back in 5 years? I'll estimate it and discount it back, and if what I get is bigger than what I invest, then I'll invest and otherwise not. But of course, that's treating your prediction as certain. You know, I know exactly what the price of oil is going to be. In fact, if the price of oil were to jump, it would be worth much more. And if it were to fall, you just stop investing. So things like oil fields or many industrial production facilities are better valued as options than in this sort of naive textbook net present value context. And when you do that, you often find that people underinvest in assets where the output price is highly volatile. Anyway, this has a huge impact on how much money you're willing to invest in oil fields or industrial facilities or mines and so on. So it turned out that we could take a lot of this very esoteric knowledge and make really practical, everyday business decisions with it. Yeah. So that was part of what was involved. And this is a message I'm trying to spread around here at Aston University, that there isn't this gap between research and research-driven ideas and things of practical value in the world outside.
And so after McKinsey, can you just sort of take us up to where you are today here at Aston Business School? Well,
I worked a lot with financial institutions, but also in buying and selling them and this sort of thing. And one of my clients was Swiss Bank Corporation, and I worked with them to buy S.G. Warburg, and then I became the global head of investment banking for S.G. Warburg, and I ran the worldwide corporate finance business. And Swiss Bank Corporation had a private banking business. Swiss banks do, after all, and it had been a neglected part of the business, so after a while I moved into that. And then we merged Swiss Bank and UBS, and it became what we now know as UBS. And so I ran, I guess, all of the private banking of UBS outside Switzerland. And then I went into the venture capital business for a while, and I was involved with some people who floated a venture fund on the AIM in 2000, and then moved back to the US for family reasons, and I started a wealth management business in San Francisco, which I ran for a little under 10 years, until I came to Aston in June of 2013.
So you've come to Aston Business School obviously from San Francisco, from your last experience in wealth management. You were saying to me that during that period as a wealth manager, director of a wealth management business, that was at the time of the financial crash. Can you tell us a little bit about that time and being involved in that very dramatic period in our economic recent past?
Yes. When operating in the business, all of the deep problems and the flaws in the financial system became quite apparent. And we were involved in this very small wealth management business in a number of quite spectacular issues, many of them relating to misuse of information by underwriters and so on. So this business grew rapidly in the beginning. It went through a very turbulent time. At the height of the crisis, I would say between early 2008 and probably 2010, firefighting every day was the rule. And then after things calmed down a bit, it started to grow again. But we had a lot of interaction with hedge funds. We had a lot of interaction with structures that subsequently collapsed. It was the kind of education you don't get in the university.
Yes, and obviously it's not actually a laughing matter what happened at that time. It's changed the world. We're now dealing with the consequences and still living with the aftermath. I know it's an area of your specialist expertise. Can you tell us a little bit about your observations about what we actually need to do in order to get over the problems that we dealt with in the financial crash?
Well, the problems of the financial crash were partly created by what I would call bad regulation and bad management, and partly they were the consequence of hubris. If you recollect, I don't know whether people do, but the 20 years before the crash were a remarkably stable period, and the central bankers were patting themselves on the back and saying they'd created a new era of stability. And this was one of the reasons why everyone felt comfortable in borrowing staggering amounts of money, because after all, what could go wrong? Everything had worked so well for 20 years. And this hubris was based on this notion that central bankers and economists had figured out how the world worked, and they knew how to control it, and so therefore we wouldn't have any problems. What has emerged, of course, is that there isn't such a deep understanding of how the world works, and it isn't possible to control things very well. And so these bets taken to extraordinary levels, you know, as it were, borrowing 95 pence for every 5 pence you actually invested of your own capital, this sort of thing, or possibly 99 pence for every penny you invested, on the notion that things wouldn't even move by 1%, you could never lose. These notions were shown to be deeply, deeply flawed. And these borrowings were everywhere. The whole world, even today, remains saturated in debt. Governments are grossly indebted. Households are grossly indebted. Many companies are grossly indebted. And despite the proclamations of the age of austerity, if we take our country here, the UK, debt keeps rising. As the government says, it's rising at a lower rate. Now, this is, I agree, an accomplishment, but it's not a reversal. And so what you can see is that in a world saturated with debt, it is very difficult to restart economic growth. It's very difficult to do a lot of things that people took for granted a while ago. And our economic understanding, our ability to prevent this happening again, hasn't improved at all. No. So there is no reason not to expect these things to recur.
No. Well, you have said in the past that one of the sort of, I suppose, fallacies of thinking is thinking that we can regulate our way out of this crisis. Could you tell us a little bit about some of your thinking around systems dynamics in economics and why we can't regulate our way out of this crisis?
So the hallmark of the crisis was that events in one place precipitated events in another place and another place and another place. And I'll give you a concrete example, which is one that I think shows how complicated the world really is and how poorly understood it was. Lehman Brothers, everyone remembers Lehman Brothers. Lehman Brothers was a huge investment bank until it collapsed. And it borrowed money on short term. It issued what was called commercial paper, and this commercial paper was seen as quite safe. And so it was held by money market funds. And in the United States, before the crisis, money market funds were a huge industry because they paid a little bit better interest than banks, so you could put your money in a bank, or you could earn a bit more and with seeming safety by putting your money in a money market fund, and they let you write checks on it. It was as if it were a bank account. So there was a money market fund called the Prime Reserve Fund. Again, probably no one in this country had ever heard of it. And the Prime Reserve Fund had bought a lot of Lehman commercial paper. And when Lehman collapsed, the Prime Reserve Fund couldn't return 100 cents on the dollar to its investors. Now, in the end, I think it returned 98 cents in the dollar, but no one had ever thought that a money market fund would be anything other than the equivalent of a bank deposit, where if you put a pound in, you got a pound out. So this caused a panic, and people started withdrawing their money not only from the Prime Reserve Fund, but from every money market fund. And this was a huge industry. Well, you say that's fine, but it was all in the US. So it turns out that in the United States, banks didn't lend more than the deposits they had. You might say, well, wait a minute, what are you saying? So essentially, banks tended to lend out in the United States, about 90% of the deposits they took in. In Europe, on the other hand, banks lend out up to 150% of the deposits. Well, where did they get the rest of the money? Well, they issued commercial paper. You think. So what happened was, when this panic happened because Lehman failed and the Prime Reserve Fund lost 2 cents in the dollar, and everybody took their money out of money market funds, European banks suddenly lost their ability to fund their loan books. The collapse of the funding caused these European banks to withdraw loans from the market. That is what caused the recession in the Eurozone. Not anything that happened specifically in Europe. So this chain of connections between the Lehman Brothers and these European banks had nothing to do with whether these European banks were investing in Lehman Brothers. They weren't directly. It had to do with this very abstract funding mechanism. And I could tell you what happened then. The European governments tried to support the banks, but of course the governments were grossly indebted and no one was buying their commercial paper or their bonds. So you know who they sold their bonds to? The banks they were supporting. Well, wait a minute. They were giving the banks money, and the banks were using the money to buy the bonds of the government that was giving them the money. This doesn't work, and that's why we have the situation we have today. This linkage, which sounds extraordinarily complicated, is one of many in the financial system that nobody understood until the crisis happened. It's dominoes which fall and knock down other dominoes, but no one even knows the other ones are there. Our whole economic system is saturated with these linkages. We globalized the world financial system from the 1970s onwards, thereby creating all these chains. So the first thing you can say is, we don't even know what's connected with what, and the financial crisis revealed that. So that was the first thing, that we genuinely didn't know how things were connected, and so things fell over in places we never expected. And the we includes all of the central banks and the regulators. Nobody knew this until it happened. And the second thing that's incredibly important is something that everybody understands but no one talks about in textbooks, which is how expectations are formed. When you invest in something, you invest in it because you think, you anticipate it will make you some money. You know, this asset will rise in value, your house will be worth more in 5 years, this company will pay dividends, whatever it is. And if everybody gets pessimistic, of course, then they pull the money back and so on. So the key question is, well, how are these expectations formed? How is it that people decide one day that everything's going up and the next day that everything is going down? Nobody understands the social psychology of expectations of gain and loss. You know, if people panic, that means they are becoming nervous. Well, what causes a panic? Why do some events cause everyone to run to the bank and take their money out, and why are others greeted with a yawn? This is fascinating from an intellectual point of view. We should all be doing research on it. But since nobody understands it, it's very hard to anticipate what will happen next. So that was also revealed in the crisis. Our central bankers and regulators didn't have a clue how the world would react to what they did, and they were constantly surprised. And I can assure you that today, from an academic point of view, we still don't have any idea of how these expectations of the future are formed. So events will happen, and they will precipitate action on the parts of millions, tens of millions, hundreds of millions of investors, and they will then put money into things and take them out, and dominoes will fall, and there we are.
So regulating bank ratios or bonuses is not going to affect this issue of the linkages, and I suppose that's one side of my question. And the second side is, given everything that you've said about systems dynamics and economics and the linkages, is that actually making its way into our consciousness, and what are we doing about that?
Well, is it making its way into our consciousness? I think to a greater extent it is at the intellectual level. I think if you went to the Federal Reserve or the Bank of England today, they understand the concept that there are linkages, whereas in 2007 they certainly didn't.
Yes.
But they don't know what they are, because remember, we have multiple jurisdictions. There are financial entities domiciled in the UK, in the US, in Botswana, in Panama. They don't exchange information. No one can build the chains of dominoes in an effective way today. So the concept, I think, is more understood, but the actual facts on the ground are still very far from understood. And as to bank ratios and bonuses, yes, I think that the real lesson is, in the absence of really good knowledge, you have to be very prudent. So you don't want to stretch yourself and take maximum gambles. The problem, of course, is that banks are not the only financial institutions. So sitting in Europe, you don't understand that, but in the United States today, less than 40% of all the credit comes from the banking system. Nearly 2/3 of it comes from the bond market, from various other capital market entities. If you take out a loan to buy a car, those loans are packaged into a bond and sold to investors. This is true for mortgages, for all these sorts of things. So the banks, which are the most regulated, are in fact a minority part of the system. Europe is different. As is always the case, the UK sits halfway between continental Europe and the United States. In places like Germany, the banking system is still extraordinarily important, and their regulating bank reserve ratios and so on is of more consequence. But the whole world is becoming more sophisticated, so the heavily regulated banking system is less and less important. And indeed, the more you regulate it, the more the money flows out of the banking system to the unregulated parts, to the hedge funds, to the private equity business. And these things are, of course, domiciled in the Cayman Islands and other places where you'll never reach them. So it's one of these little eels that struggles in your hand and slips out. And so it is possible to regulate some things. It is not, in the current environment, possible to regulate enough.
No, but
so what's the conclusion from this?
Well, one of the things you've talked about is shining more light onto dark pools, that is having over-the-counter trading as much as possible. Will that sort it?
Yes. Let's talk about this wonderful word, rehypothecation, which sounds like an illness that you get when traveling. So you might think of a mortgage. In effect, a mortgage is a loan collateralized by a house. You say to the bank, I want to buy this money and I'll give you my house as the security for the loan, right? And you think, well, you know, I've got the money, but there's the house. So when you borrow to buy securities, you can go to a bank and say, I'd like to buy some securities and I'll pledge some collateral. They might say, yes, if you put up 40p, I'll lend you £1 because the variation in the value is less than the 40p. So you think, fine, I've got 40p in collateral in this bank. Well, it turns out that in the UK, the bank can take your 40p and use it for itself and borrow against that again. So you foolishly think you can always get your 40p back from the bank, and in fact, it's gone. It's been rehypothecated to another entity. So even though you own it legally, unambiguously, if the financial institution took it and used it for its own collateral in another transaction, and if that institution then goes bankrupt, you have nothing. This is an extraordinary legal thing. Until I understood it, I couldn't imagine that such a thing could be the case. And so what you see is that I think the World Bank or the IMF made a calculation that the amount of supposed collateral in the world that was claimed by various financial entities was 2.5 times the amount that actually existed. Which means that, roughly speaking, if everyone tried to claim the collateral back, they'd get 40p in the pound. So our financial system is riddled with things like this, which are bizarre and absurd, but again, amplify risk, because you see there isn't collateral behind these things. There's, in aggregate, 40p in the pound of what you thought was there. So there's a huge amount of work to try and clean up this system. Obviously, rehypothecation is a wonderful idea for the financial institution because it gets to use your money for nothing. Now, that sounds like a good deal from someone's point of view. And therefore, they fight tooth and nail to prevent that. And since the people they employ are called lobbyists, and because they make what are called contributions to political parties, it's highly unlikely that these laws will be changed. And so we live in a precarious world with these funny legal structures where no one knows exactly what's going to happen next.
Well, given all of that complexity, you have, like many economists, said we've got 3 ways out: default on our debt, inflation, and growth. And you've just talked about the difficulties of growth. We know where we get to when we talk about default, and the Greeks are having some discussions around that at the moment. And obviously growth then is the final challenge. In the beginning of this discussion, you talked a lot about Stanford and the entrepreneurial ferment of those days, and you've come to Birmingham, and we are faced in Birmingham and the Midlands obviously with our own growth challenges. Can you give us any tips, observations on how we might really accelerate that process?
Well, one of the things that drew me here, in fact, was the amount of entrepreneurial activity here. I mean, if you think of, we're sitting here in the business school, and not far away is an accelerator, which had its origins with us and is now an independent entity. And it has at any time, I think, 60 to 65 startup businesses in it. I think if you take the greater Birmingham area, there are probably 700 or 800 startup companies around here at any time. This is, in fact, an area with a lot of entrepreneurial activity and a lot of creative activity. So it has a very substantial potential. I think Birmingham is an odd mixture of an industrial past that's now in decline, and a very interesting set of new growth opportunities, some of which are, of course, in the very large service industry that's springing up in the centre of the city, and the rest is in these startup enterprises, which you literally see ringing the entire metropolitan area. So I don't think there's a shortage of entrepreneurial enthusiasm here. I think there are other issues, but the sort of native enthusiasm, I would say, is actually abundant in this area.
So what are some of these other issues then, the challenges sitting around the native enthusiasm? How would you...
There are 2 types of challenges. One of them is a financial challenge. If I contrast San Francisco, where I came from, to Birmingham, there are many contrasts: the weather, the view. Money is available in California for ideas in abundance, in extraordinary abundance. If you have an idea that sounds halfway plausible, you'll find dozens of people who want to talk to you. And they're willing to put up substantial amounts of money even for quite unproven ideas. Here, new ventures, if they can get 5,000, 10,000, 20,000, 50,000 pounds, they think it's a staggering amount of money. Who would get out of bed for this amount of money in California? You know, you ask for 100,000, a quarter of a million, $1 million, then you start to get into real money. This is a really significant issue because there are very few things that can be started literally on a shoestring. Video games can, because you really need a computer and you can do that on a machine. But if you want to make something, if you want to make an object, you have to make a prototype. You have to deal with physical material, raw material. That's expensive to handle. Metal is expensive to handle. Plastic is expensive to handle. You make 100 or 1,000 of them before it works. So you need much more money to start I don't know what we should call it, a business that makes physical objects of any sort rather than that's purely driven by software. Our Vice Chancellor, Julia King, says you really need, and she was an engineer, she says you really need to put in somewhere between £500,000 and £1.5 million into object-making activities to start something up. Well, as anyone who's tried to get venture money in the Midlands knows, that's an awful lot of money, an awful lot of money. And indeed, I'm on the board of a spin-off from Aston, which is in the optical area, and makes a combination of software and things. It's very hard to raise hundreds of thousands of pounds, but you have to raise that kind of money. So the first issue, I think, is a general reluctance to put up money in the amounts and to take the risks that are needed. But the second thing I think is more fundamental. It's my good fortune here to talk to lots of people who are entrepreneurs, aspiring entrepreneurs. A lot of the students come to my office to talk about these things. To risk a generalization, I would say that the level of aspiration, what constitutes success, is much lower here than it was where I came from in California. What people think of as a big success, as a lot of money, as a victory here, is just very small. It's not small relative to, say, average incomes or something like that, but you know, someone here might be happy to make £1 million or £2 million or £3 million. That sounds like an awful lot of money. Well, think about it, right? I mean, in California, you know, who wants to settle for a couple of $1 million when you might make 10 or 50 or 100 or more? And whether you do or not is not the issue. Very few people, in fact, become Bill Gates or Elon Musk or something like that. But the only way to have any of them is for many people to aspire to this, to be willing to step out, to reach for more, to try and create something bigger. And so part of it is financial, but part of it is really what people are willing to settle for. And this is a sort of a social or a psychological phenomenon that is very noticeable to someone who comes from the outside.
So how do we raise the level of aspiration, George?
I don't know the answer to that question. I would put it back to you, as I have to many people here in Birmingham, that one didn't have to ask this question some time ago. The Midlands were the cradle of the Industrial Revolution. 20 minutes from where we're sitting, the world was changed. People took enormous entrepreneurial gambles, mortgaged everything they had, took great chances, developed railroads and steam engines and all sorts of industrial chemicals, and transformed the world of fabrics and apparel, and did everything. All around us are, if you like, monuments to the industrial history. We're sitting in the Silicon Valley of the period from 1750 to about 1860. I mean, we're in the heart of it. So this area had people who were willing to take enormous risks and entities that were willing to fund them to do it, and people who were willing to fund them to do it. So I would turn the question around, Beverley, and say, what happened? I can't answer that. I come from somewhere else. But it's not an attitude that's, in a sense, alien either to the UK or to where we're sitting right now. But it's very noticeably more modest, this aspiration, than it should be.
Well, maybe I can't answer your question directly, but just to pose another one on the back of what you've been observing, one of the things that you have talked about just in that answer is the appetite, the hunger for knowledge of the entrepreneurs, their need to take knowledge and use it to create things, as you said earlier, nobody even knew that they wanted. How can we actually sort of help our entrepreneurs out there maybe raise their aspiration by helping provide them with greater knowledge that gives them insights that none of us already have?
One of the things that characterizes the many entrepreneurial locations in the US is very well developed networks of people who are willing to help someone with entrepreneurial ideas. If you want to talk to people, if you want to get advice, if you want to connect with people who will work with you, it's very easy. It's very easy in Austin, Texas, and Salt Lake City, Utah, and Seattle, and San Francisco, and San Jose, and Brooklyn, and Lower Manhattan. You can find whole groups of people who work together, who support each other, who you can use in effect as mentors or discussion partners, counselors. All of these things are essential in understanding what the possibilities are for an idea and developing it and so on. We need to develop much deeper and richer networks of support for people with entrepreneurial ideas. We need people who have been successful in the past to be willing to step up, not even to put up money, but just to counsel people. This is how you do it. These are the things that work. Why don't you try this? I've been here. Abandon that. Take another direction. It's this kind of advice which you really can get from all sorts of people in the US that needs to be expanded here. And here at the business school, we're building up some of these networks with our alumni. The Midlands is full of extraordinarily successful people, and we're trying to engage more of them. But I think if we could just build that support network, that experience would help people and would help them move faster and make fewer mistakes.
So systems of collaboration, we seem to be coming back to linkages again, where we started this conversation, I think, a little bit earlier, but systems of collaboration, articulating those, enabling much greater transparency into sources of knowledge. You believe that is certainly one thing that we could be, and that you already are here at Aston Business School, we could collectively be doing more to help our entrepreneurs here in the Midlands.
Yes, I believe that we need to go beyond the conventional structures we have. We have chambers of commerce and so on, but what we really need are networks of people who have common entrepreneurial interests, who support each other and work with each other. I'll give you a small piece of that. You know, we run the Goldman Sachs 10,000 Small Businesses program here in the Midlands, and there we take cohorts of 30 people who own small businesses, who have been profitable for a while, who have been growing, and who are desperately eager to grow rapidly. They go through a filtering process, they apply for this program, and it's a few months, and we teach them, in effect, you can think of it as a mini MBA. But the real point of this is that these classes, let's call them with 30 people in them, they're not conventional academic classes. Our faculty turn up, but a lot of the examples are raised by the people themselves in their own businesses. They go and try these things in their own businesses, and they speak with each other. And so by the end of these cohorts, after about 4 months, these people are their best friends, and they ask each other for advice. They don't come to us, they start working with each other. And what we have created is a kind of alumni network of people who have similar aspirations. They're all in different businesses, you know, but they have this common desire to succeed, this common desire to grow. And most of the issues are not specific to the business. You know, how do I hire someone? How do I make a good personnel judgment? How do I change my compensation system? How do I decide how much of an investment risk to take? You know, these are questions which you can apply in all sorts of contexts. And so they help each other. And this help accelerates the process. So you could say, we believe we've made a very material difference to their ability to operate. We teach them, you know, a bit more about accounting or marketing or finance, but they also teach each other and they support each other. That little network example is what we need on a much grander scale throughout this area. And if we had that, then I think we would see a lot of the potential, which is really abundant here, turning into something much more substantial.
Well, I think that's a really practical example, and I'm very conscious we've been enjoyed a very good conversation, but in rolling out that idea, is there any one practical bit of advice that you could give to us to how, is it just a simple matter of setting up more of those across our universities? Is it as straightforward as that, George?
I don't think it's the universities only at all. I think what we need to do is to bring groups of entrepreneurs together. We need to create forums, places in which people are actually welcome. A lot of the world now is based on self-assembly rather than formal organization. I have 3 daughters, but the oldest one is working in her second startup in New York now. She decided she wanted to learn about big data. It's a hot topic. And she didn't go to a university. There is an entity in New York called General Assembly. You've never heard of it, probably. It's a collection of technical specialists in a variety of data-related fields who run an impromptu university. It isn't accredited by anybody and it doesn't give degrees, but it's extraordinarily well known. To get into it is very difficult. They interview you, and for a period of several months they teach you, in this case, big data. She is a graduate of a self-assembled university by people who had an interest in it. Now, why would they do it, you say? Because the charges are minimal just to keep the thing rolling. These are their future employees. Remember, we're in a war for talent. How do you find skilled people? Well, once you've trained yourself and seen if they work, they're the best ones. So everybody benefits, and this is entirely self-assembled education. So what we need to do is to provide people with like interest, a place to get together, opportunities. We should set these things up. We should encourage them to do things like the equivalent of General Assembly. And we will build a vibrant community of people with common interests who want to create new enterprises, who want to create economic growth. I am very much in favour of self-assembly, of voluntary activity. I think we can facilitate, you know, I'm happy to let the premises of our business school be used for these meetings. I'm sure you are too. Yes, yes. But we aren't going to make this happen. Our faculty will be happy to participate. The students will be happy to participate. We have to make it easy for people who want to do this to do it. We aren't going to create a structure and a governance and all of this. I think that the one of the many lessons of the burst of innovation we've seen in the last few years has been the spontaneity, as I say, the self-assembly, the invention of things people didn't know they needed, doing things in ways people didn't understand. This is the future. So
it's about empowerment, unleashing the energy, the sort of energy that resides within the individuals, and not sort of over-engineering solutions, perhaps.
Yes, I think you have to find people with like interests. It's not just empowering everyone you meet on the street, but it's saying to people, yes, you're all working in this area, you're trying to set up these businesses. Aren't you interested in talking to others in the same situation? Of course you are. If you've ever run a business, you are the loneliest person on the planet, the loneliest person. And you want people to talk to you, and you want other people's experiences. If we can facilitate that, we will do more than anything else I can think of to accelerate the growth. With that one exception, we have to provide some more finance.
Yes. Well, thank you very much indeed for all those thoughts, George. It's been a great pleasure talking with you. Thank you very much.
Thank you.